In the world of investing, we often hear about the importance of assets, those tangible things like factories, capital, and inventory that a company owns. And from those, the sales, the expenses, the very things that we base our fundamentals out of. But what about the intangible assets, like reputation and brand? According to Warren Buffett, one of the most successful investors of all time, these intangible assets are of the most importance for value-driven investors. But how can this elusive reputation transform into a company's unbeatable advantage? In fact, even Buffett himself wasn't always a believer in the power of intangible assets. Early in his career, he was focused solely on tangible assets because of its straightforward evaluation. He once wrote, "I was taught to favor tangible assets and to shun businesses whose value depended largely upon economic goodwill." But by 1983, his perspective has shifted dramatically, thanks in large part to the success of See's Candy Store, a company owned by Berkshire Hathaway. So how exactly did a mere candy store change his perspective? See's Candy was able to produce about $2 million a year after tax on just $8 million in net tangible assets, which is pretty impressive. But how did they garner so many sales? Buffett attributed this success to the company's subjective competitive advantage, which he describes as a pervasive favorable reputation with consumers based upon countless pleasant experiences they have had with both product and personnel. When Berkshire Hathaway acquired See's, they paid a premium for these intangible subjective assets, which Buffett calls the company economic goodwill, and that investment paid off handsomely. A few years later, See's was earning 65 of its net tangible assets after tax, making it an even more robust and profitable business. But here's where it gets really interesting. During times of inflation, conventional wisdom suggests that companies with lots of tangible assets are the safest bets. They have the factories and machinery to weather the storm, so to speak. However, Buffett found that these asset-heavy businesses generally earn lower rates of return that often barely provide enough capital to fund the inflationary needs of existing businesses. And he's right, asset-heavy businesses constantly need to refinance and fund more capital to increase their operations. On the other hand, companies like See's, with relatively few tangible assets but combined intangibles of lasting value, actually perform better in an inflationary environment. They have fewer costs to cover and higher rates of return on existing capital. See's keeps minimal inventory and accounts receivable, so when prices go up, they don't have to spend a fortune just to keep things going. Instead, they can gradually increase their prices over time without losing customers. As Warren Buffett aptly concludes, during inflation, goodwill is the gift that keeps on giving. So, what's the takeaway here? When evaluating the real value of a service or a company, it can be difficult to analyze those intangible assets. They might not show up on a balance sheet, but they can make a significant impact on a company's bottom line and its ability to weather various economic conditions. Whether you're an investor or a consumer, it's worth paying attention to these less tangible factors. They just might be that competitive advantage you're looking for.